What is going on, guys and gals? Your average investor here. Looking to talk a little bit more about the bond series. This is going to be part 2 in our multifaceted how to invest in bonds, what to look for, how you can diversify your portfolio, and why you'd want to. So today we're going to be talking a little bit about what and how to think about investing in bonds. Part 1 kind of gets into the whole description as to what they are. Bonds are essentially loans that you make to a company or to the government, and in return you get a periodic interest payment. So you get what's called the coupon. And what the coupon does is it actually lets you receive basically the equivalent of a dividend with the promise that at some point you'll receive the full amount or the principal when the bond has matured or when it has reached maturity at a predetermined date. So risk versus returns. Bonds are generally considered less risky than stocks. When you invest in bonds, you're prioritizing essentially the stability and the income over higher returns. Stocks can go parabolic. You're not going to see that with bonds, but you're going to get this consistent income at intervals that are determined on the bond that you select. Some are biannual, some are quarterly. Typically biannual is the most popular, although there are annual ones. So just a different way to think about how you can diversify your portfolio while prioritizing stability and income over these higher returns. So why are bonds useful? Steady income. Bonds are going to provide that regular, predictable income throughout the coupon payments. Capital preservation. Bonds are less volatile than stocks. They help protect your investment from market fluctuations, and they offer diversification. So they help balance a portfolio that might be higher at risk, and they tend to perform better or more well when stocks are performing poorly. So if your stocks are rising, bonds tend to be flat. Vice versa, if stocks typically go down, bonds will stay consistent and over time outperform the underlying stocks. So how can you value bonds? A couple different ways here. They have a face value, which is also known as the par value. Some of this is going to be a little bit technical as far as terminology goes, but we're going to keep it really simple for you. So face value is the bond's original price. It's usually $1,000, and you'll receive this back when the bond matures. So if you ever see a bond and you say, hey, what's the face value of this bond? Basically, how much money are you putting in for the loan? If it's a $5,000 original price, you could say the face value is $5,000. Then we have the coupon rate. So this is the interest rate that the bond pays. It's typically a percentage. You usually see these percentages of, hey, the coupon rate is 3%, or it is a percentage of the face value of the original loan. So all these fancy terms of bonds, the easy way, guys, to think about this is the face value, or what does the bond cost. The coupon rate is what is the yield or the percentage that you're going to get. And then there is the current yield. So this is the bond's annual interest payment divided by the current price. It helps investors understand what they're earning based on the bond's market price. And the last one is, the yield to maturity. And this is the total return expected on a bond if it's held until maturity. So it takes into account the bond's current price, coupon payments, the time remaining until maturity. There's some nice calculators that you guys can find online with this. There's the yield to maturity versus coupon rate. A bunch of different ways to think about this. Some fancy calculations. I would recommend just using a calculator online. Save yourself the headache of the time, and you can also find out pretty quickly what is going to be the best value for you. So why do bond prices change? If they're paying these consistent incomes, if we know the underlying investment is going to be a flat rate of 1,000 or 5,000, why do the bond prices change, and why do people trade these? Well, interest rates alter the appeal of the underlying bond. So if interest rates, when they rise, bond prices fall. There's a direct inverse relationship there. So investors demand a higher yield, so they pay less for the existing bonds with a lower coupon rate. So conversely, when interest rates fall, bond prices come up. You're going to have to pay a premium on the bond prices as interest rates go down. And the reason being is if you lock in the current bond price, let's say your rate of the bond is 5% and inflation brings it down to 4%, well, the bond is going to pay you more than the current inflationary rate. So that's a huge factor in how bonds are priced. Now, credit ratings are another one. If a company's credit rating improves, the bond becomes less risky. Likewise, when a government's credit rating improves, if the government stability of a third world country or an emerging economy improves, the bond becomes less risky because there's less chance of that country defaulting on it or that company defaulting on it, and thus the prices tend to rise. The reverse is also true. If a company becomes more skeptical in the marketplace, or there's a higher likelihood that they may default. In that situation, the credit rating typically goes down, and thus the bond price will also go down. Finally, there's also some supply and demand that plays into this. If there's high demand for a company's bond price, a company bond, the prices may increase. Vice versa, as you guys see that there's less interest in a specific bond, those prices typically do come down. So why do some companies issue bonds while others don't? Well, a lot of times there's a need for capital. So companies issue bonds to raise capital for operations, projects, some things like that. Some might choose to issue equity or sell stock instead. Not saying one is right versus the other one. And then the last thing is the credit worthiness. So companies with lower credit ratings, they will also lower their credit rating. They may struggle to issue bonds or may need to offer higher interest rates to attract investors. Debt strategies. Some companies prefer to borrow via bonds rather than diluting ownership with new issues of share. So there's a lot of different factors as to why companies issue bonds while others don't. Lastly, why are some bonds higher coupon than others? Well, again, going back to the original discussion about credit risk and market condition, companies or governments with lower credit ratings, they have to offer a higher interest rate to attract investors because they're more risky. You know, for instance, if your friend had a company and you know this friend and you're saying, oh man, I just don't know if he's going to make it. He's going to have to entice you and give you more money on both the back end and the duration of your investment with him for you to be interested in doing it. You know, there's a risk reward. Everybody has their own opinion on their own level of risk. Again, if you're an average investor like us, you're going to be taking all these into consideration when you're thinking about investing, well as also market conditions. So if interest rates are high at the same time of issuance, new bonds will offer higher coupons to stay competitive. Older bonds may be locked in at different rates. They may be below the inflationary or the market condition. They may be above it, which makes them more attractive because then people want these higher coupons. And sometimes bonds will then call early, which there has to be provision in it, and we'll get into that later. So, to end, we're talking about some quick buzzwords, or what are some of the words that are used commonly in bond language. Big one that we talked about, coupon. This is just simply the annual interest payment made to the bond holders. This is usually expressed as a percentage of the bond's face value. There's the yield to maturity, usually abbreviated as YTM, which I threw that up right in front of you guys right here. It's a calculation on the total return of the bond if it is held until maturity. This factors in the bond's price, the coupon payments, the time till maturity. There is what is called the par value or the face value. This is the bond's original price. It's usually in $1,000 increments, and it is repaid at maturity. So you're going to get your money back for the initial investment that you put in. There is the maturity date. This is pretty straightforward. This is the date when the bond's principal will be repaid to you. Basically, when does the bond expire? You get your money back at that point. The duration, again, very straightforward. How sensitive a bond's price is to changes in the interest rate. The longer the duration, the more a bond's price will fall if rates rise. And the reason being is, for bonds, typically that means you're going to be locked into a longer pay period when the rate is either moving up or down, which can cause a problem. So duration is a big one to pay attention to. There's also what I talked about briefly, the callability. Some bonds can be called or they can be repaid earlier by the issuer. So if the company gets into great financial position, they may recall the bond, say, look, thank you guys for your money. We're going to pull these things back in earlier. We don't really need them anymore. This is usually pretty common when interest rates fall, which then allows the issuer to refinance the bonds at a lower rate. Kind of hurts the bond investor, but I get it. Credit ratings, this is another buzzword. Bonds are rated by agencies. There's two big ones, Moody's and Standard & Poor, and they basically rate the issuer's ability to repay the debt. Higher bond ratings like AAA bonds are safer, but they will typically pay lower interest rates because, they're more safe investments. And then the final one is the default risk. Got to be careful with this one. The risk that bond issues will not be able to make the interest or principal payments when they're due will play into your ability to get paid on these instruments. So that's bonds part 2. Next, we're going to be talking a little bit about what are some of the top or most common ones in the marketplace, how you should diversify, how you should think about this. Again, none of this is investment advice. This is all speculation, more of an educational tutorial on how to think about the bond market and how your average investor can get into it. Final note, if you guys haven't subscribed or turned the notifications on, please do so. We're trying to monetize the channel. We'd love to get this out there so we can run some more of these fun raffles, these giveaways, and really help out the average person. Thanks again. Talk to you soon.